Welcome to Yadnya Investment Academy. In our earlier videos, we have studied risk and return parameters like standard deviation, alpha, beta, and Sharpe ratio to understand how to read performance of various funds. And in this video, we are going to see how these parameters can be used to compare two funds. Before we actually compare funds, let's quickly go through what these four parameters mean. Standard deviation is the value by which the returns of a fund may go up or down in correlation with its mean or average returns. So, a lower standard deviation is better as it means that the fund is less volatile and would give returns around its mean. A beta value indicates how closely is the fund related to the index it follows. The beta value of an index is always considered to be 1. So if a fund has a lower beta value, it means that this fund will gain less when the markets move high and will fall less when the markets move down in comparison with the index. Similarly, if a fund has a beta value higher than 1, it means that this particular fund will make more gains when the markets rise and will fall more when the markets move down. You can multiply the beta value of a fund with the percentage gains made by an index which the fund correlates to and easily predict the returns of that particular fund. An alpha value of a fund indicates the amount of returns generated by the fund over and above the ones predicted by its beta value. So let's say a particular index has gained 10%. A fund that it correlates to has a beta value of 1.1. So as per the predictions, this particular fund should make 11% returns. But let's say the fund has actually made 14% returns. So this particular fund has generated an alpha of 3%. So a higher the alpha, the better it is, but it has to be consistent in a fund. Again, a beta value higher than 1 is desirable because it indicates that this particular fund would make better returns than the index. The higher the Sharpe ratio, the better it is because when you compare two funds, a fund with a higher Sharpe ratio indicates that that particular fund is generating more returns for the amount of risk it is taking. Please do remember that none of these parameters should be read into isolation but should be read together to analyze risk and return associated with the fund. Now let us move ahead to the example. Whenever you compare two funds, they should fall into the same fund category as the risk and return of each category is different. The funds should also relate to the same benchmark, then the comparison becomes fair. In this example, we are taking two funds which belong to the equity mid-cap category and the benchmark is Nifty Free Float Mid-Cap 100. The funds are Birla Sun Life Mid-Cap Fund and HDFC Mid-Cap Opportunities Fund. A fund should also be compared with its benchmark on all the risk-return parameters to understand whether the fund is actually doing well or no. P/E ratio of a fund indicates whether the fund has some growth potential or no. As you can see, the P/E ratio of both these funds is far below than the benchmark, which indicates that these funds have growth potential. At the same time, they are less riskier than the benchmark. Now the P/E ratio is almost same, so let's move on to the next parameter. 3-year trailing returns of both these funds are around 30% and the difference is lesser than 1%, so they are almost equal. Standard deviation is the amount by which the returns may go up or down in correlation with its mean. So, a lower standard deviation is what is desirable. And as you can see, Birla Sun Life Mid-Cap Fund has a higher standard deviation as compared to HDFC Mid-Cap Opportunities Fund, and so the HDFC fund scores here. The beta value of a fund tells you the correlation of the fund with its benchmark index. Birla Sun Life Mid-Cap Fund has a beta value of 1.1, which indicates that this fund would gain more when the index benchmark rises and would fall more when the index falls. Whereas the beta value of HDFC Mid-Cap Opportunities Fund is lesser than 1, indicating it is less sensitive than the index. Now we had seen a higher beta value is what is desirable, but let's evaluate all the parameters together. Let's move on to the next parameter, that is alpha. Now an alpha value indicates the amount of returns generated by the fund over and above the ones predicted by its beta value. As you can see, the alpha value of HDFC Midcap Opportunities Fund is greater than Birla Sun Life Midcap Fund. But the beta value of the HDFC Midcap Opportunities Fund was itself lower, predicting lower returns, and so the alpha value here is higher. And so in this comparison, alpha value should not influence our decision too much. Moving on to Sharpe ratio. Sharpe ratio tells you the amount of returns generated per unit of risk taken. So, a higher Sharpe ratio is what is desirable. And so, HDFC Midcap Opportunities Fund scores here. Looking at all these parameters together imply that HDFC Midcap Opportunities Fund is able to produce same amount of returns for lower risk taken. Now the lower risk taken is also evident from the beta value, which indicates that this particular fund will fall less when the markets fall. And so, based on all these current values, HDFC Midcap Opportunities Fund seems to be a better choice. Friends, hope the video was able to explain how to look at risk return parameters in unison and then choose your fund. Thanks for watching this video. Watch this space for more such topics. Until then, happy investing. If you have any questions, let us know in the comment section below our videos. And if you like our videos, please do subscribe. Thank you.